Hey everyone, great to be back with you all. I'm Anselm. Today, let's dive into a topic that's been rattling the market lately, the non-stop outflows from spot Bitcoin ETFs. A lot of people are asking, is institutional money officially throwing in the towel? First, let's look at the data. Over the past week, spot Bitcoin ETFs saw a net outflow of around $1.72 billion. Even worse, we're now on a 4-week losing streak of continuous redemptions. That's not pocket change. It's a clear sign that short-term market sentiment has turned pretty cautious. But here's the thing, we shouldn't just look at this and assume institutions are over Bitcoin. If you look closer, the bleeding is mostly coming from the biggest players. BlackRock's IBIT shed about $1.34 billion. Fidelity's FBTC lost around $201.9 million, and Grayscale's GBTC saw about $144.3 million walk out the door. So why are the giants getting hit first? Well, it's actually a purely practical move. These funds are massive and have deep liquidity. When big institutions need to quickly de-risk or rebalance their portfolios, they start with the assets that are easiest to buy and sell. So BlackRock taking the biggest hit isn't necessarily a massive bearish signal, it's just standard position management. The real culprit behind this capital flight is the macro environment. Recent US jobs data came in hot, which pushed Treasury yields up and completely killed the market's hope for interest rate cuts. And as we know, the moment rate expectations shift, high volatility assets get squeezed. Now that Bitcoin is part of the traditional financial system via ETFs, it's tied at the hip to US Treasury yields, dollar liquidity, and global risk appetite. The takeaway? This ETF outflow looks less like an exit from Bitcoin and more like institutions repricing their macro risk. So how do we know if the situation is actually getting dangerous? I'm keeping an eye on a few specific signals. Whether long-term holders are moving huge chunks of BTC onto exchanges, whether stablecoin liquidity is drying up, whether we're seeing massive liquidations in the derivatives market, and whether miners are dumping their holdings. If all these red flags light up at the same time, then yeah, we're in trouble. But if the selling is only happening on the ETF side, while on-chain long-term holders are staying strong, then this is just a healthy flush out of risk, not a total trend reversal. By the way, Ethereum ETFs aren't having a great time either. They've seen about $885.6 million leave over the last 4 weeks. This tells us the pressure isn't unique to Bitcoin Dash. The entire crypto asset class is feeling the chill from a broader macro slowdown. But don't mistake this for total panic. Interestingly, some smaller cap altcoin funds, like those tracking capital HYPE and capital XRP, actually saw inflows. This proves that capital isn't fleeing the crypto space entirely, it's just rotating into pockets where investors see a bit more resilience or upside. Look at it this way. The non-stop outflows from spot Bitcoin ETFs mean institutional appetite for risk has taken a breather. It doesn't mean they've given up on Bitcoin. What we're witnessing is just the growing pains of Bitcoin being integrated into traditional portfolios. It's standard rebalancing. At the end of the day, price is just the symptom. Capital flow is the cause. I'm Anselm. I don't gaze into crystal balls to predict prices. I just follow the actual money moving on-chain. If you want to stay ahead of the curve on market dynamics and capital flows, make sure to hit that subscribe button. See you in the next video. Let the data do the talking.